A bond is a formal debt instrument issued by a company to borrow money. The issuing company receives cash by selling a bond to an investor. In return, the issuing company promises to pay back to the investor 1. A stated amount referred to as the principal or face amount at a specific maturity date, and 2. Periodic interest payments over the life of the bond. Bonds are very similar to notes. Bonds, though, usually are for greater amounts and are issued to many lenders, while notes most often are issued to a single lender, such as a bank. Traditionally, interest on bonds is paid twice a year on designated interest dates, beginning 6 months after the original bond issue date. For most large corporation, bonds are sold or underwritten by investment houses. A company issuing a bond pays a fee for these underwriting services. Other costs include legal, accounting, registration, and printing fees. To keep costs down, the issuing company might choose to sell the bonds directly to a single investor, such as a large investment fund or an insurance company. This is referred to as a private placement. Now, why do some companies issue bonds rather than borrow money directly from a bank? A company that borrows by issuing bonds is effectively bypassing the bank and borrowing directly from the investing public, usually at a lower interest rate than it would in a bank loan. However, issuing bonds entails significant bond issue costs that can exceed 5% of the amount borrowed. For smaller loans, the additional bond issuance costs exceed the savings from a lower interest rate, making it more economical to borrow from a bank. But for loans of $20 million or more, the interest rate savings often exceed the additional bond issuance costs, making a bond issue more attractive.